Have you ever wondered why understanding the taxable house rent allowance matters so much? It's a question that may seem complex, but we're here to unravel it for you. In the next 2 minutes, we'll delve deep into why this component of your income is so crucial. To begin with, taxable house rent allowance, or HRA, is a significant part of most people's salaries in India. It's essentially an allowance given by employers to cover the cost of renting a house. And the best part? It's partially or fully exempt from taxes under certain conditions as per the Income Tax Act of 1961. Now you might be thinking that's great, but how does understanding this help me? Well, knowing the ins and outs of your HRA and how it's taxed can help you make more informed financial decisions. It allows you to plan your expenses better and even maximize your take-home salary. For example, if you're aware of the exemptions and conditions related to HRA, you can effectively reduce your taxable income. This, in turn, reduces the amount of tax you owe at the end of the fiscal year. It's like putting money right back into your pocket. But it's not just about saving on taxes. Understanding how your HRA works can give you a clearer picture of your overall income and help you manage your finances more efficiently. It can help you budget better, save more, and even plan for a more secure future. Now, all this ties back to the Income Tax Act of 1961. This law is the backbone of income tax rules in India, and it's where the regulations on HRA come from. It outlines the conditions under which you can claim tax exemptions on your HRA and how to calculate the taxable portion. So, as you can see, understanding the taxable house rent allowance is not just about the numbers, it's about gaining financial literacy and becoming savvy with your money. It's about being proactive and planning ahead. Understanding the taxable house rent allowance is not just about saving tax, it's about being smart with your hard-earned money. Before we dive into the calculations, let's first grasp the basic concept of house rent allowance. House rent allowance, more commonly known by its acronym HRA, is a component of a salaried individual's income. It's an allowance provided by employers to employees to cover the cost of renting a home. It's one of the many elements that make up your comprehensive salary package, alongside your basic pay, dearness, allowance, and others. Now, why is it essential to understand HRA? Well, under the Income Tax Act of 1961, a portion of your HRA can be exempted from your taxable income. This means that you can effectively lower your tax liability, enabling you to save more of your hard-earned money. However, it's crucial to note that not all HRA is exempt from tax. There are certain conditions under which your HRA becomes taxable. Let's shed some light on these. Firstly, the HRA exemption is only applicable to salaried individuals who live in a rented house. If you own the house you live in, this exemption doesn't apply to you. Secondly, the exemption is based on the city where you reside. If you live in a metropolitan city like Delhi, Mumbai, Chennai, or Kolkata, you're entitled to an HRA exemption of 50% of your basic salary. For non-metro cities, the exemption is 40%. Thirdly, the actual rent paid by you, minus 10% of your basic salary, is also considered for exemption. It's important to understand that the lowest of these three amounts will be considered for your HRA exemption. So it's not as simple as saying, I receive an HRA, so it's all tax-free. In essence, your HRA can be both a taxable and non-taxable component of your salary, depending on various factors. This duality is what makes understanding HRA and its tax implications so significant. Now that we have a basic understanding of house rent allowance, we can move on to the calculation part. Now, we dive into the heart of the matter. How do we calculate taxable house rent allowance? First things first, let's understand that the house rent allowance, or HRA, is a component of the salary package and is usually around 40 to 50% of the basic salary. It's important to note that the actual amount of HRA exemption is the minimum of 3 figures, which we will calculate shortly. Now, let's take an example. Imagine a person named Ravi. He's employed in Mumbai and earns a basic salary of 50,000 rupees per month. His employer provides him with a house rent allowance of 20,000 rupees per month, and he pays a monthly rent of 22,000 rupees. Step 1 in our calculation is to find out the actual amount of HRA received by Ravi. So, in our case, that's 20,000 rupees per month or 240,000 rupees annually. The second step is to calculate 50% of Ravi's basic salary because he lives in a metropolitan city. If he lived elsewhere, we'd consider 40%. So 50% of his basic salary, which is 50,000 rupees, amounts to 25,000 rupees per month or 300,000 rupees annually. The third step is to compute the rent paid by Ravi in excess of 10% of his basic salary. So we subtract 10% of his basic salary from the actual rent paid by him. Let's calculate, shall we? 10% of 50,000 rupees is 5,000 rupees. So the rent paid in excess is 22,000 minus 5,000, which is 17,000 rupees per month, or 204,000 rupees annually. Now that we have our three figures, we need to find the smallest one. These figures are the actual HRA received, 240,000 rupees, 50% of the basic salary, 300,000 rupees, and the excess rent paid, 204,000 rupees. The smallest figure here is 204,000 rupees. So the amount of HRA that is exempt from tax for Ravi is 204,000 rupees. To find the taxable portion of the HRA, we subtract this from the actual HRA received. So his taxable HRA is 240,000 minus 204,000, which equals 36,000 rupees. And voila, that's how we calculate the taxable house rent allowance. It's a simple process of comparing three figures and choosing the smallest one, then subtracting it from the actual HRA received. As you can see, calculating taxable house rent allowance is not as complicated as it seems. While calculating taxable house rent allowance, people often make some common mistakes. First off, many individuals believe that the entire amount of the house rent allowance HRA they receive is exempted from tax. This is absolutely not the case. The tax exemption on HRA is the least of the following three: actual HRA received, 50% of salary in metro cities or 40% in non-metro cities, or actual rent paid minus 10% of salary. Another common misconception is that if you live in your own house but still receive a house rent allowance, it will be fully exempted from tax. Again, this is incorrect. If you live in your own house and you're receiving HRA, it's fully taxable. Then there's the belief that you can claim HRA exemption without providing any proof of rent payment. While it's true that you don't need to submit rent receipts to your employer, you do need to maintain them for your own records. If the income tax department decides to audit you, they may ask for these documents. A frequent mistake is not including all components of your salary while calculating the HRA exemption. Remember, salary for this purpose includes basic salary, dearness allowance, and any commission based on a fixed percentage of turnover achieved by the employee. Ignoring these elements can lead to incorrect calculations. Another common error is not considering the city of residence. As mentioned before, the tax exemption is 50% of salary in metro cities and 40% in non-metro cities. So your city of residence plays a critical role in the calculation. Lastly, many people believe that they can claim HRA and home loan benefits simultaneously. This is true, but only in certain circumstances, like if you have a house in one city but work in another. By avoiding these common mistakes, you can ensure that your taxable house rent allowance calculation is accurate and reliable. Let's wrap up what we've learned today. We started off by shedding light on the importance of understanding taxable house rent allowance. It's not just about compliance with the Income Tax Act of 1961, but also about making the most of your hard-earned money. We then dived into the basic concept of house rent allowance, explaining how it can influence your tax liability. It's not as daunting as it might seem once you get the hang of it. Then, we walked through the step-by-step process of calculating taxable house rent allowance. Remember, accuracy is key here, and it's essential to include all relevant details. We also highlighted some common mistakes and misconceptions. Falling for these can lead to inaccurate calculations and potential tax issues. By understanding these key points, you're well equipped to handle your house rent allowance calculations. With this understanding, you can now calculate your taxable house rent allowance accurately and make smarter decisions about your income and tax savings.